Welcome back to New Money. This evening we discuss estate planning. My guests, Harry, Joffe and Gordon Stuart. If you'd like to say some or question us, you can always phone us. Our number will appear on the screen. You can also email me on brian@bdtv.co.za. I'm going to just deal with a question that just before coming on the show, I received a call from Jack in Edenvale who asked me to please answer the following question. He's recently sold a building owned by a trust. His daughter, who's been living in America for over 20 years, is a beneficiary of the trust. She still has a taxable income in South Africa because the South African trust attributes income to her, and that's obviously for tax reasons. Jack wants to transfer $5 million to her in the USA, and he wants to know how it should be done. He also mentioned that even though the trust attributes incomes, it's never been distributed before. This will be the first time. Harry?
Right, so this is quite an involved question. I'll try to just keep it as simple as I can. So first of all, remember, a South African trust can't directly send money offshore. It has to use the beneficiaries, and the beneficiaries can take the money offshore. So the first principle is the trust will make a distribution to the daughter, who, as we said, is a beneficiary. They'll tax her, and then the money will belong to her in South Africa. So that's
tax her on what basis?
Well, they'll tax it depending on the source of the...
Let's say the source is capital.
Then they'll tax as a capital gain. So let's say they sold a building, so we assume it's a capital gain. Then they'll tax her up to 18%, depending on the extent of the gain and her tax rate. So after tax, she'll get the money. Now she's going to take the money out the country. And this is where it gets tricky. There's a SARB circular from last year, May 2021, which says if you're no longer tax resident in South Africa, then you don't get the R1 million single discretionary allowance. It falls away. Now, we're not sure if she's tax resident here. We know she's a taxpayer here, but she's been living in America for 20 years. We assume she's tax resident in America. So that would mean she wouldn't get the R1 million single discretionary allowance here. She would have to apply for a tax clearance certificate here to take the R5 million out. So she or her tax advisors would apply to SARS for the R5 million tax clearance certificate, which she would get because they can show the source of the funds, and then she would take the money out the country. But it's quite an involved process because to apply for the tax clearance certificate, she needs a tax number. They said she's a taxpayer, so I assume she's got a tax number. So then I assume that process would work. If she doesn't have a tax number here, then they'd have to get her a tax number, register as a taxpayer, and then they can apply for a tax clearance certificate for her. So it's not a straightforward process because we've got a trust involved, but the bottom line is she can get the money out.
Okay. Gordon,
sorry, Brian, can I add to that?
Yeah, please.
So, I mean, Harry's given a great explanation from a South African perspective, but she's been living in the US for 20 years. So I'm going to take a stab and say that she's a US tax resident. Now, the US income tax law contains a number of regimes designed to discourage exactly what has been happening, which is the accumulation of income in offshore structures for later distribution to a US taxpayer, especially after they've escaped or deferred US taxation offshore for one or a number of years. Now, one such regime applies to what we call the foreign non-grantor trust with a US beneficiary. So a foreign non-grantor trust is in essence what we in South Africa would just simply call a discretionary trust, which has been established by a non-US person. So this is where it starts getting quite interesting because in short, and the regime, which is kind of the slang word or the commonly referred to as the throwback tax, this imposes a punitive tax on income earned by the trust in 1 year, but not distributed to a trust beneficiary until a later year. And this undistributed income is called UNI, or undistributed net income. So when the UNI is distributed to a US beneficiary in a year after the year in which it was earned by the trust, the beneficiary is taxed as if the UNI had been distributed to him or her in the year that it was actually earned by the trust, but that he or she had failed to report it. And the consequences of this are that there's interest charges are imposed for the deemed late payment of tax, and certain categories of income which would otherwise be subject to preferential tax rates will lose their preferential tax treatment, which can result in an additional 20% of tax. So the longer the trust has been accumulating income, the greater the problem becomes.
Yep. Gordon, just a question there. Would you suggest that Jack actually consults with his accountants or with a specialist in this particular field?
Well, Bryan, it's going to be a couple of specialists, and this is the whole beauty when you've got cross-border transactions like this. So just to finish off what Gordon was saying, you need a South African tax specialist to give the tax side in South Africa. You need a US tax specialist to work out the tax side in the US, and those two have to coincide and talk as well, because there might be a middle way here. And it might pay Jack not to make a distribution to the daughter. It might pay Jack to take out some kind of investment in the trust and keep it in the trust, because as Gordon's saying, there could be a penal tax back in America. So, she might not live in America for the rest of her life. So it's a very tricky situation, this, and we need tax experts in both jurisdictions. And that's often the mistake. You only look at the tax in the one side of the fence. You don't look at both sides of it.
Gordon, question for you. Previously, South Africans could not pass on assets invested offshore to South African. However, now, following the budget, it can be done. Please explain the change in Forex.
Okay, excellent. So, I mean, Bryan, it looks like Saab is full of gifts at the moment. I mean, we had the one last year where they took away the looping, and then on the 23rd of Feb, well, effective the 23rd of Feb this year, Saab have made also the following changes to the Reserve Bank regulations. So there's a couple that I'm going to touch on. The first one is residents may now receive and retain gifts. I'm going to underline that little word gifts and inheritances from non-residents offshore without notifying Saab. Now, the reason why I underline gifts is that because this is a change from the previous position where offshore inheritances received after the 17th of March 1998 from a bona fide non-resident estate could be retained offshore on condition that it would not be placed at the disposal of another resident. But gifts from non-residents had to be declared and repatriated unless a special or a motivated application was submitted abroad. Right, then the second one, legitimate foreign assets may be placed at the disposal of another South African resident. So in addition, inheritances comprising of legitimately held foreign assets may be received offshore from another South African resident. What did it used to be? Well, the previous position was that foreign assets could not be placed at the disposal of another SA resident, and inheritances from an SA resident would need to be declared, and upon approval of a motivated application could be retained offshore, obviously subject to the condition that these assets would not be placed at the disposal of an SA resident. And then finally, the big surprise is that the allowances in excess of 10 million rand, so what we would call the special dispensation allowance, this may now be contributed to offshore companies or trusts. No prior approval is needed for funds which are currently held via this special application, but annual reporting is required as well as statements evidencing the value of the assets offshore. And the previous position was that the special dispensation allowance had to remain in the individual's personal capacity at all times, and that individual was prohibited from contributing those assets to a trust or a company.
Bryan, just one, Gordon's, it's spot on. I just want to add one important point where our viewers mustn't get confused. So those South African can transfer legitimate assets offshore to another South African, that, as Gordon said. We took opinion on a little extra grey area. Can South Africans share their allowances or their bank accounts to take their allowances out the country? And Saab came back to us very firmly and said no. So though I can take my R1 million out, convert it to dollars and give that to another South African, I can't use someone else's bank account to take the money out, and I can't share bank accounts with someone else, and we can't mix and match the allowances. Saab are still very strict on that. So I have to take my 1 million out through my bank account, my allowance, and you've got to take your 1 million out through your bank account, your allowance. And of course, the other point is the minute you make an asset available to another South African, you transfer that asset across, then of course all the taxes would apply, capital gains tax and maybe donations tax.
Harry, if I take $1 million out, my wife takes $1 million out, can we invest in a joint account offshore?
Yes, and now you can. So now you can, because you've taken it out through your allowance legitimately. She's taken it out through her allowance. As long as you've got two separate South African bank accounts, then you can mix it into one account offshore now, because that's exactly what Saab was saying.
Let's try and get through one more email, Harry. Barbara in Scarborough says, we are planning on immigrating and we have retirement annuities. If we decided to cash them in now and draw annuity, where will the tax be paid? Then in 3 years' time, we'll be able to draw the remaining cash in the RA, or it's better to nothing and wait for 3 years and then cash in the RA.
Okay, so Bryan, so let's just set the rules. Rule number one, If you retire your RA, which is the first part of the question, so Barbara retires from her RA or RAs, matures them, then she can take 1/3 in cash, which she can take out the country, but the balance of the 2/3 has to buy an annuity in South Africa, fixed or living, but that money is stuck in South Africa for good. She can't take that capital out, whether she immigrates or not. She can take the monthly annuity out every month, but the capital's stuck here. If she waits for 3 years, so she leaves the country, leaves her RA as is, waits for 3 years, so she's no longer tax resident in South Africa for a 3-year period, which is uninterrupted, she can then cash in her RA and take all the money out. But if she cashes in her RA and takes all the money out, then that's seen as a withdrawal, and she would pay tax on the withdrawal tables, which are more penal. If she retires from the RA, she can only take the 1/3 out, but then it's much more favorably
You
taxed.
get the 500,000.
Correct.
Harry, I do want to add the second part of the question. Let me add to this. If people living overseas have been away for more than 3 years, can they now access their retirement?
Yes. Yes, sir. As long as they are non-tax resident for an uninterrupted period of 3 years, which starts from the day they became non-tax resident, they can cash in their RA, as long as they haven't matured it. Obviously, if they're really retired from their RA, as I said, then they can't cash it in. If it's sitting here and it's not being cashed in, they can mature it and take it out. Now, the tax, again, with an RA, this is a problem. The double tax treaties cover pension funds, provident funds, and other annuities. They don't cover RAs. SARS's view is that an RA is a private fund, not an employer fund, and only pension and provident funds can you benefit from the double tax treaty, not RAs. So the RA will always be taxed in South Africa. We've had a few cases where SARS have not allowed the double tax treaty to be used for an RA.
Well, Gordon and Harry, I've given you a pretty easy evening because we've got about 12 or 15 emails we never got through.
Thank you.
It's quite amazing how intimidating it is when dealing with financial and estate plan. The major portion of our life is geared towards learning and acquiring the skills necessary to help us secure work and then make money. Not enough time is dedicated towards how to make it work for you and to prepare an updated and regular financial and estate plan. Empowerment is taking charge of your finances and will ensure that on your death, your family affairs will be in good shape. Harry, Gordon, thanks for joining me. Gordon, I hope to see you in South Africa sometime. It's important to note that our program is to provide information and should not be construed as advice. Next week's program will be dealing with financial and retirement planning, and if you need to get hold of me, my details will appear on the screen. Thank you for watching, and good night.